Yeah, so still with 2021 paper. So we're going to the last question. This is the last question of 2021. I don't know if it's my light is distracting. Yes, so I think we did this question one time. So we've been given information here and we've been asked to prepare the statement of financial position as well as the statement of profit and loss account. So in our case, this is a situation where these are ratios. We've already been given the ratios now. They would want us to convert this information that we have here into the statement of financial position. In the other questions, you'll find that you've already the statement of financial position and the profit and loss have been prepared for you. You'll be asked to convert that information into the ratios. In this case, we are doing the other way around. So we're going to start the question. So I've already drawn the lines. So the first step is asking us to prepare the statement of profit and loss account. So in order for us to prepare the statement of financial of profit and loss, we have to start with our sales. So in our question, they're saying Choir can remember that this is revenue for the year totaled 300,000. So that is the first step that we're going to begin with. So this is Choir profit and loss account. So we're going to begin with our sales. So our sales figure have already been given to be 300,000. Going to cost of sales, first thing to appear is our stock, which is the opening stock. Now going through the question, it is saying opening inventory at selling price was 73 days, which is based on revenue. So since it is 73 days, we're going to say the 73 days which is given divided by total number of days, which is 365. We have that figure there times our revenue, which is 300,000. We have 60,000. And then we said when we're calculating inventory turnover, we're supposed to add our opening and closing inventory, then divide by 2. Now in this case, the things have been separated for us. So in order for us to go back by the equation, we're going to multiply the figure that was attained here, multiply by 100 over 150 in order for us to come back. This is the formula which has already been given in the question, because sometimes we'll be asked to calculate the average inventory, in which we're supposed to add the opening inventory plus the closing inventory. Then the figure that we're supposed to get, we'll divide it by 2. That is the average inventory figure. Now in the case where we've been given, in this case, we're supposed to add the two figures. In this case, we're supposed to add the two figures, then multiply by 100 over 150, which is what I've done here. So we have our inventory to be 40,000. Then next, we need our purchases. In purchases, we don't have any information on purchases, which means this is an incomplete record, which we are going to leave that part empty. So we'll leave it empty. So if we added our purchase plus this figure, we're supposed to find our cost of goods available for sale, which we do not know since we don't know the value of purchases. Then from the figure to ascertain here, we're supposed to less our closing stock. So from the closing stock, we've not also been given information, but all we know that closing inventory at selling price was 109.5 days. It was 109.5 days. So 109.5, we're going to divide by total number of days is 365. The figure that we have, we're going to multiply this by the revenue, which is 300,000. The figure that we found same applies. We're going to multiply by 100, then divide by 150. For anything to do with inventory, that's what we're going to be doing. So we have our 60,000 here. So the figure that we're supposed to find here minus this closing stock that was attained, we're supposed to find our cost of sales figure. But still, since we already have some missing figures, we'll not be able to find our cost of sales. So we're going to leave it empty like that. And then we've been given information on the gross profit. Remember, if we subtract the sales minus cost of sales, we're supposed to find our gross profit. But the gross profit information has already been given. Gross profit, they're saying, according to the question, they're saying gross profit, there's a gross profit markup of 50%, and I said a markup is charged on cost of sales, while a margin is charged on sales. So in our case, since we already have a margin, we already have our sales figure and the markup, which means we have to convert the markup into a margin in order for us to find the value of gross profit. If it was a cost, or if we already had the cost of sales figure, that percentage that we had was supposed to multiply direct on it, then we're able to find our profit. But in our case, we've already been given a markup and the sales, which means markup and sales don't work together, which means we have to convert it into a margin. And to convert it to a margin, we're going to get the same figure to have. In this case, it is 50%. So 50 over 100 plus the 50. 100 plus the 50, which is going to give us 150. So we have 50 divided by 150. The figure that we found now, we're going to multiply by our sales figure, which was 300,000. So we have 100,000 as our gross profit. So we've only done this because we've been given a markup and sales. If we had the margin, we're going to go direct by getting the percentages we have been given on the gross profit times our sales. But in our case, we have a markup. A markup doesn't work with sales. You have to convert it into a margin. By converting it into a margin, you get the figure to have been given, divide by the same figure to have been given plus 100. That figure that we're going to find now, you multiply it by sales. That's what we have done there. Then we have our gross profit figure. Since we still have some missing values, it's this figure that we're going to use in order for us to come back and find the missing values. So in our case, remember, the figure that is here is the figure to subtracted in order for us to arrive at this figure. So which means we're going to get directly this figure here minus this 100, which is going to give us a 200. Which simply means the figure that was supposed to subtract here in order for us to find the 100 was supposed to be a 200. Now, since we still have missing figures here, which means this figure which was here, they added this. Sorry, the figure that was here, they subtracted this in order for them to arrive at this, which simply means we're just going to add this back. So if you add this 200 plus the 260 plus the 6,000, which is there, we're going to get cash. The figure that was here was supposed to be a 260,000. And since we know that there was a figure that was supposed to be here, which they added to this 40 in order for them to get this 260. So we're simply going to get the 260 that we have here minus the 40,000, which is going to give us the figure that was supposed to be here, which is going to be a 220,000. So in this case, we are done with the trading profit and loss account. Moving forward, we're supposed to less our expenses in order for us to ascertain our net profit, and we do not have the value of the expenses, which means we're going direct to the net profit. So since we don't know the value of expenses, we're going to write the information, of course, less expenses, which we don't know the information. Then if we less our expenses, we are supposed to arrive at the net profit. But the net profit, we've already been given information saying there's a net profit margin of 10%. There's a net profit margin of 10%. So that one is a direct entry. So since it is a margin, it will be treated direct. So 10% is 10 over 100 itself. 10% is 10 over 100 times our sales revenue, which is 300,000. So our net profit is 30,000. So since we know that there's a value of expenses which was supposed to be subtracted from this 100 in order for us to arrive at this 30, which simply means we're just going to get the 100,000 which is there, direct subtract by 30,000. What is going to remain is our expenses figure. In this case, we're going to remain with a 70,000. Okay, yeah. So since there's a subtraction, we're going to put the 70,000 in brackets. Okay, so we are done with the first part, that is our net profit, which we are working on in order for us to find. So moving forward, we're going to the balance sheet or statement of financial position. Statement of financial position. So we know that the first step we're supposed to find our non-current assets. Non-current assets, but we don't have any information on non-current assets, which means we're going to skip that part. Then we're going to go to our current assets first. On current assets, we've been given this information saying there's a current ratio of 2.9, which means for every amount of money, for every one quarter that the business is owing, there's 2.9 that is available to pay. Remember, current ratio, it is current assets over current liabilities, which means this information is what we're explaining about the current assets and current liabilities. So in order for us to find the current assets, first list them. So on current assets, we know that is stock, which is stock that comes in the balance sheet is the closing stock. And going back in the question, we had our closing stock to be 60,000. So stock itself is 60,000. Then debtors, or what we call receivables. Our receivables figure, we are given information saying receivables payment period was 45 days. Receivables payment period was 45 days. So we're going to get the receivables, the 45 days which we've been given, direct, divided by total number of days, which is 365, times our sales revenue. Sales revenue is 300,000. So our receivables are 36,986. 36,986. Then we need our bank information, which we don't know, but for the total we've been given. So in order for us to find the total, we've been given the payables information on the we are given the receivables payment period and payables payment period. So receivables is treated with sales, which is credit sales, but in this case we have not been given any information concerning goods that were sold on credit. So we're going to use the sales figure. That's what we have used. Then on payables, we're going to use our purchases figure. So they're saying on payables, they're saying 60 days. Payables payment period is 60 days. So 60 divided by 365, which is the total number of days. The figure to have, we're going to multiply by our purchases, which is 220,000. So if we do that, we have our payables to be 36,164. Of our payables to be 36,164. Now this is the information that we're going to use in order for us to find the total amount of assets. So since we are given this ratio, which means the payables we are going once in order for them to arrive at the 2.9. So we're going to get this figure of ascertained times the 2.9. So the total amount of assets was supposed to be 104,876. So since we have some information which is missing here, we're going to get this figure minus these two. So the figure to have there minus 104,876 minus 36,986 minus 60,000. So assets figure is supposed to be 7,890. That is our cash either at the bank or cash in hand. Since we know that we are going by the capital employed method, so these assets that we have, we know that it is assets is equals to capital plus liabilities, and this can be broken as non-current assets plus current assets is equals to capital plus non-current liabilities plus current liabilities. So if you are going by the capital employed method, we are going to get the current liabilities to bring them on the debit side, bringing them on the asset side, which means since it was a positive number, when they come that side, it's going to be a negative number. So which simply means we're going to subtract this. So the 104,876 that we have, we're going to subtract our 36,164. So our capital employed there is going to be 68,712. Okay, and then we know that there's a value of non-current assets that we're supposed to add to this in order for us to find our non-current, our capital employed, and we don't have any information on this. But yet in the question we've been given information on it, net profit was over divided by capital employed to be 30%. So they're saying net profit over capital employed. So capital employed we've been given a percentage is a 30%. So 30% is 30 divided by 100, which is 0.3, and they're saying net profit over capital employed. So our net profit was 300,000 divided by 0.3, the 30%. So sorry, net profit was a 30,000 divided by 0.3, which simply means our capital employed should have been 100,000. Our capital employed should have been 100,000. Since we know that there's a value which is supposed to be added to this in order for us to find this value, so we are going to get this value direct minus this value in order for us to come back to the missing value on top. So the figure to have there minus 68,712. 68,712. We have our non-current assets to be 312,88. So we're done with the first part. Going to the last part, we are going direct by the financed by. So we have our capital. So our capital, we've not been given any information on capital, so it's also a missing entry which we're going to leave at this moment. Then you know that it is a capital which we don't know plus net profit, and our net profit, it was already 30,000, which was supposed to be added to our capital in order for us to find this value which is here. Remember, these values have to balance, which value which is here. So which means in order for us to ascertain the value of capital, we're going to get this value here direct minus this one, which is going to give us our capital to be 70,000. So like this, we are done with question 5. Let me say with the last question in 2021 paper, and then I think I sent some questions in 2022 paper. That was question 1, I think, and also question I think I sent question 1 and question 3. Yes, I think question 3. Yes, so we're going to go to question 2. We're going to question 2. Yes, so question 2, we've been given a cash flow statement. Let me say we've been given statement of financial position as well as the income statements for 2 comparative years. We have information for 2001 and information for 2002. Then we have also been given income statement for the current year. Remember, if we've been given two years, you're going to use the current year. We don't need any information from the previous year. So in this case, we've just been given the current year and also 2 comparative years for the statement of financial position, in which we're supposed to do the cash flow statement. So in the cash flow statement, you know that we are only interested in the movement of cash. So in our case, if we didn't have any bank overdraft, we are saying if at start we had the cash of 1 kwacha, how are we arriving at 2 kwacha? Where is the 1 kwacha coming from? So that's the thing that we're going to work on to find where is the 1 kwacha coming from. But in this case, there's an overdraft, which means if at start we had a 1 kwacha minus the overdraft itself. So an overdraft was a 98. So 1 minus 98. So which means at start we had a negative 97. Then at the end we're arriving at 2 minus the overdraft, which is 85. At the end we're arriving at negative 83. Okay, so in order for us to find the difference, what has increased or what has reduced, we're going to get the closing minus opening. So minus, that is the closing, minus opening was 97. It was already negative 97. So that figure minus negative 97. So we're supposed to find where this, let me do it. So I have a 2 minus 85, which is 83. So we have negative 83 minus negative 90, sorry, let me do it again. So at start we had the 1 kwacha minus the 98. So at start we had a negative 97. Then at the end we have a 2 kwacha. We have a 2 kwacha plus short-term investment of 52. That is giving us a 54 minus the overdraft of 85. That is giving us a 31, negative 31. So negative 31 minus the opening, which is negative 97. So minus negative 97. So where is this 64 coming from? Where is this 64 coming from? So 52 minus 85 is negative 33. So negative 33 minus negative 97. Yes, where is this 64 coming from? So to find the difference, the figure that we're supposed to get, you're just going to get our opening cash and cash equivalent. That is our cash plus if there's any short-term investment. So in our case, at start, we don't have any short-term investment. Remember, first short-term investment is here. We don't have anything. There's empty, but there's a 1 kwacha. So at start, we have a 1 kwacha minus the overdraft, which is 98. So 1 minus 98, that is where the negative 97 is coming from. Then at the end, there's a short-term investment of 50 kwacha and there's cash of 2 kwacha, that is making a 52. So 52 minus the overdraft, which is 85. 52 minus 85, which is giving us negative 33. So the negative 33, which is the closing, at start we had a negative 97. So the negative 33 minus negative 97, we have the 64. Where is this 64 kwacha coming from? So everything that we are going to be doing, we're supposed to get this difference of 64 kwacha. So we're going to write our heading, our cash flow statement. Cash flow statement, okay. So we're going to start with our operating activities. And the first thing to appear under operating activities is supposed to be our profit before tax. And going in our question, our profit before tax is 300. Profit before tax is 300. Okay, then here we need information like depreciation. If there's any asset that we sold, how much did we sell it? That's not what we're interested in. We're interested in what was the profit or what is the loss. And also we have to check through our operating profit, that is the profit before interest and tax, and the profit before tax, everything that is between. So in our case, our operating profit or profit before interest and tax is 350 and our profit before tax is 300. So what is between? In this case, we have two things. There's interest received and interest paid. Even when you have 100 things that are there, you're supposed to bring everything. So in our case, there's only interest received and interest paid, but we are supposed to look for every information that is between the operating profit, or what we call profit before interest and tax, and the profit before tax. Everything that is between, we are supposed to bring it. So in our case, there's interest received. So let's bring it. There's interest received, which is interest received, which is a 25. So that since that one was added, we're going to subtract it. By subtracting, we're going to put it in brackets, and then there's interest paid. Interest paid of 75. Since that one was subtracted, we're going to add it. Then next, now we're going to work on our depreciation. So for depreciation, if you don't have any other information on anything that was sold down in the part where there's adjustment, if you don't have anything that was sold, which means we're going to get the opening depreciation. In this case, there's a accumulated depreciation down there. There's accumulated depreciation. At the end, it is 340. At the end, yes, at the end it is 340. At the start it is 295. Okay, it is 295. So we're just going to get the difference then, and that's the depreciation that we're supposed to use. In some question, you are going to find depreciation is given in the income statement, which means you are simply going to get it direct. So in this case, since there were some assets which were sold, we are going to get the depreciation of the asset that was sold. We're going to add it to the closing, even to closing depreciation, then we subtract our opening. So what I'm saying is, in this case, the question is saying, fixtures and fittings an original cost of 85 and a carrying value of 45. If the original value was 85, for it to reach at 45, which means it lost value, and the loss of value, that is depreciation itself. So 85 minus 45, we have a 40. So which means this 40 was depreciation of the asset that was sold. So we're going to add it to the closing depreciation. In our case, the closing depreciation, this is 2002, 2021 is here. So 2002 is our closing. So our closing depreciation was 340. So we're going to add it to the 340. So we have 380 minus the opening, which is 290 depreciation there, accumulated depreciation minus 290. We have the depreciation to be 90. Since it is depreciation, we're going to add it here. Depreciation to be 90. Next, we are interested in what did you sell? What was the loss on what we sold? What was the profit on what was sold? So in our case, they said with a carrying value of 45, we are sold for 32 during the year. So they're saying the net book value, the carrying value was 45. Then they sold it at 32, which means there's a loss of 13 kwacha. So since there's a loss or profit, those I think that we're interested in the first place. So loss on disposal is going to be a 13. Since it's a loss, we're going to add it. If it was a profit, we're supposed to subtract. Then we're going to go through the question to check what else was sold. So in our case, there's investment on non-current assets. There's investment which has a value at start, at the end there's empty, which means these investments were sold. So in coming down in the question, they're saying the current asset investment made the definition of cash equivalent. No. The proceeds from the sale of non-current asset investment amounted to 30,000. So the value of these assets were 25. Now they sold them at 30, which means there's a profit of 5 kwacha. So that 5,000. Remember, I have zeros on top. We have zeros on top. Sorry. So there's a profit of 5,000. So since it's a profit, you're supposed to subtract it. So there's a profit on non-current asset investment. There's a profit of 5 kwacha. Since it's a profit, we are going to put it in brackets, mean that we're subtracting. So we're done with the first part. All we're interested in is what was the loss on what was sold, what was the profit on what was sold, what was the depreciation, and also we're checking for anything that is between our operating profit and the profit before interest and the tax. So in our case, we're done with the first part. So we have a 300 minus 25 plus 75 plus 90 plus 13 minus 5. Sorry. 300 minus 25 plus 75 plus 90 plus 13 minus 5. This is 448. Okay, that is under operating activities. We are still going. So we're going to our working capital changes. Under working capital changes, in every question, just like I said in the other question, in every question there's you are supposed to have 6 things here. 6 things. Of course, one of them might be missing, one of them might be a 0, but you can still write it so much that you're going to be familiar with what you are doing. You know that I'm supposed to have 6 things here. So if one of them is 0, you can still indicate it and write a 0. Okay, so first of all, you're going to check on our inventory. What is happening to our inventory? Is it increasing or decreasing? So in our case, inventory at start, inventory was 102, at the end is 150, so there's an increase in inventory. So increase in inventory, so it is 102. Yeah, let us stop operating. 102 102 minus 150. So inventory is increasing by 48. So since inventory is increasing, which means we went on to buy. Inventory is talking about the stock, the goods that are available for sale. So if inventory at start was 102, at the end of 150, which means we went to buy another 48,000 more. So cash went outside, is going to appear inside. Next, increase in receivables. Increase in receivables. So receivables at start, it was 315, at the end it is 390. So 315 minus 390, 315 minus 390, we have a 75. So since receivables are people that are owing us money, people that borrowed from us. So if at start, people were owing us, people borrowed our 315, at the end people have borrowed us money are equal to 390,000, which means they came to borrow more, which means our cash went outside. That means it's an outflow, cash went outside. That's why we're putting it in bracket as well. Next, increase in payables. Payables at start we had 119, at the end we have 127, So which means it is increasing by 8, and payables is the amount of money that the business is owing. We are owing other people the money that doesn't belong to us. So if at start we are owing 119, at the end we're owing 127, which means we went to borrow more. Our cash came in. It is not our money, so cash came in. So that is an inflow. No wonder I've indicated it without brackets. The next thing here, we need our tax paid as well as interest paid, as well as dividends. Dividends, some question is to be given direct, and some other question is supposed to calculate. So for tax paid, you can simply draw, I think I can still use this part. You can draw a T account. So going down the question, there is a taxation. So taxation, they're saying at the start it was 240, at the end it is 290, but also in the income statement there's information on tax. They're saying income tax was 240. So which means we're going to get the opening balance brought now. Tax is a liability, which means it has a credit balance. So balance brought down, the balance at start was 240. So balance brought down, which is the 240. Then balance at the end, which is the carried down, is 240. It is 290. Then the tax that was incurred during the year, you're also going to put it on the credit side. So income tax was 240. So even this one here is 240. Then you're going to balance this up. 240 plus 240, that is 480. 480 minus 290. So 480 is the total both sides. So we have a 480 minus 290. So we have a tax difference of 190. So which means this is the tax that was paid. If at start we had the balance of 240, at the end we're incurring the tax balance of 290. Then during the year we still incurred 240. How are we arriving at 290? Which means that there's a 190 that was paid on the tax. So that is the something that we're interested in. So the 190 tax is going to come here. Since we paid, cash went outside. Cash went outside. Then next, we're going to do the same things to our interest. Balance brought down of interest. In this case, interest. Okay, in this case, we don't have the opening and closing balances, but if you had it, you're supposed to put the opening balance here and the closing balance here, and the interest which is in the table, we'll put it here as well. When you add this, the total you're going to find, you're going to put it both sides, then this minus this, then that is the interest that was paid. So in this case, since we don't have any information on the opening and closing, we're just going to get the interest that is in the income statement. In our case, it is 75. That is the interest that we are going to use. Then for dividends, it is profit for the year. In this case, our profit for the year was a 60 plus the opening retained earning. Our open retained earning, it was 100. So 60 plus 100 is 160 minus closing retained earning. And in this case, our closing retained earning is 160. So the 160 minus 160 is going to give us dividend of 0, which means we don't have any dividends. In some other questions, dividend is a direct entry which is given. So we have a 448 on top minus a 48 minus the 75 plus 8 minus 190 minus 75, okay, which is giving us a 68 here, a 68. Then next we are going to our investment activities. Under investment activities, we're interested in things to do with our non-current asset. What is happening to our non-current assets? How much did we buy in the year? How much did we sell? Okay, so first of all, we're going to start with our purchases of non-current assets, what we call PPE, purchases of non-current assets or acquisition of non-current assets. Non-current assets. Okay, so at start we had the cost of assets to be 720, at the end 595. Okay, that information itself is enough, yes, in order for us to find assets that were bought during the year. But then since there are some assets which were sold, which means that value of the asset which was sold is not in the closing balance of assets, which means we're supposed to add it back in order for us to subtract the opening. So since the question was saying fixtures and fittings with the original cost of 85, so we're going to be interested in the original cost. So if the original cost was 85, which means and the closing balance of assets was 720, we're going to get this 85 plus the closing balance, which is 720, the figure that we have, this was supposed to be the value if if the 85,000 assets were not sold, which means this was supposed to be the value, but now assets worth the 85,000 were sold. So we've added back the 85 to the closing, which is 720. We have 805 minus the opening. Now in our case, our opening was 595, which simply means the assets during the year that were bought were 210. That's the difference. It's only that some assets, the balances of some assets were not included in the closing because they were sold. So we have added it back to the closing, then minus opening, which means this is the value of assets which were sold. But also there's what we call a valuation surplus. Valuation surplus, which simply means assets increased value by itself. We're saying this is the amount of money that we bought assets, but they're saying some assets increased value by itself. So supposed to subtract that one also. So at start, the valuation surplus was 91, at the end it is 100, which means it just increased by a 9. So from this figure, we're going to subtract it. From it was a 210 minus 9, we're going to have a 201. So which simply means we bought assets worthy 201. Since we bought assets, the value will be put in brackets, which simply means cash outflow. Then purchase of intangible assets, anything that is under our non-current assets, what we're interested in here. If these intangible assets were not there, we're not going to include it here. So for intangible assets, we know that the opening value was 200 at the end of 250, so which means during the year they bought a 50. Then proceeds, like the assets which were sold, how much did they sell them? That's the other information that we're interested in. So proceeds from assets. So we go back to the question. The question was saying these assets were sold for 32. So that 32 is what we are interested in. The proceeds are just how much did you sell them. We're not interested in if there's any loss or profit, but how much did you sell them. So that is the 32 that we brought down there. And also, let's not forget the non-intangible assets that were sold as well. The first adjustment, the proceeds of the sale of non-current asset investment amounted to 30,000. So we also need investments to be 30,000. So 30 proceeds, cash came in. And also we should not forget the interest received. The interest was received because they borrowed money. What we had to do was, these debtors, they were buying things, so now they acquired our money and then they had to pay an interest on it. So it was because of a non-current asset, that's why we received that interest. So that one is also part of the intangible asset. So we're going to include our interest received here, which was a 25. We're going to bring it back. So we have a negative 201 in brackets there, which simply means a negative, sorry, my calculator is not well, minus 50 plus 32 plus 30 plus 25. We have a negative 64. We won't write a negative 64, we'll just put it in brackets, which simply means a negative. So we're done with our investment activities. Moving forward, we'll go to our financing activities. This part has everything to do with our financed by part. So here we have share capital. So share capital at start, we had the 150, at the end 200, so it is just increased by 50. Then we also have share premium. Share premium at start, we have 160, 150, it's just increasing by 10. Then also loan itself at start 0, at the end 100, so it is increasing by 100. So this in total is going to be 160. So negative 64 plus 160, we have now, 164, negative 164 plus 160, we have a negative 4 plus the 40 plus the 68, which is on top, we have the 64. So this is the figure that we're supposed to find, just like we confirmed on top. So this is our cash stroke cash equivalent. So much that if you add our opening, we're going to arrive at the